Even with the broader real estate trust stocks down 12% so far this year, the dividend REITs I'm about to show you are up more than 4% and beating the market by 14%. These REITs offer not only that upside potential, but also a solid dividend cash flow and the opportunity to diversify your investments away from stocks. In this video, I'll share the 5 best dividend REITs to watch and the one every investor should be buying. It's the 7th in our Just One Stock series. If you could invest in just one stock in the different themes, which would it be? We're going to cover all the strategies here, from value to growth, bonds, and tech stocks. And by the end of the series, you'll have a portfolio of the very best stocks to buy. So join the community and watch each week for that new episode. Up until now, we focused the series entirely on stocks, and that's always going to be the biggest part of your portfolio. But now we're getting into an entirely new asset class, and that's more important than most investors realize. I want to get into our list of dividend REITs, so I'll explain why that is later, along with what to look for in these real estate stocks and the best REIT for your portfolio. First on our REIT list is one I've been watching closely this year, Gaming and Leisure Properties, ticker GLPI, with its 5.4% dividend yield. The company owns 52 properties in 17 states, many without a competitor for more than 60 miles. Its casinos are operated by some of the biggest names like Caesars, Boyd, and Penn National, with gaming and over 15,000 hotel rooms. Besides that growth in gambling that we're just starting to see across the United States, I really like this company's strategy. It contracts with operators on a triple net basis, that triple in, so the casinos pay all the costs, including maintenance. Strong contract terms mean GLPI has been able to keep 100% occupancy since its inception. Now, we all know this property type got hit hard in the pandemic, but free cash flow is already on its way higher. The company generated $728 million in free cash flow over the last year, nearly double the $424 million in 2020 and above pre-pandemic as well. Now, I feel like the pandemic wiped out the weaker REITs in this space and the casino players in the industry, leaving leaders like GLPI to take that market share and emerge stronger. And besides that strong dividend yield, the shares are beating the market by nearly 20% so far this year, and I really like the growth story here. We're just getting started, and I feel like if you've clicked through a video on dividend REITs, I probably don't have to convince you why you should be investing in these. And maybe I'm just biased since my first internship was as a commercial real estate analyst, but nation, no other investment has created as much legacy wealth as real estate. Not only does real estate offer some of the high returns we'll look at, but a way to smooth out some of the risks you get with stocks. But REITs also are an easy way to invest, trading just like stocks without the tens of thousands you need for a down payment. As for how much you should invest in dividend REITs, it's really going to depend on how much safety and cash flow you want. I would say a minimum, though, maybe 10 or 15% of your wealth in real estate or REITs. If you want more cash flow, just to diversify your stock portfolio a little bit more, maybe you go as high as 25 or 30% in REITs, while younger investors that want more growth probably go with a little bit lower allocation. Blackstone Mortgage Trust, ticker BXMT, is one of the few mortgage REITs to be holding up really well this year, and I like being able to add that mortgage component to the list. Remember, instead of owning property directly like traditional REITs, mortgage REITs borrow on those short-term rates and then leverage that money 3 and 4 times higher with debt to invest in mortgages. So the mortgages might only pay 3 or 4% interest rate, but with that leverage, mortgage REITs can cash flow to pay a higher dividend, like Blackstone's 8.2% yield. The REIT holds 157 loans on a portfolio of $22 billion and originated $4.7 billion in loans just last quarter, so it's growing consistently and that dividend is fully covered by the earnings. Just under half the portfolio is in multifamily loans, with another 29% in office space, but you've got some diversification here with that remaining third in other property types across the US and even Europe. Mortgage REITs have been hit this year because those higher interest rates on new loans means the old loans are worth less to investors. Mortgage demand has also slowed down as those rates increase and home buyers are getting squeezed. It's likely this is going to get worse before it gets better, and we're already seeing some of the smaller mortgage companies go out of business. Blackstone Mortgage, though, is well capitalized and has the liquidity of a giant investment powerhouse behind it. Blackstone did well throughout the pandemic, with the loan-to-value on the portfolio never exceeding 66%, so really high-quality real estate here. It's increased earnings consistently, and book value has grown to just under $27 a share, which means the stock trades for a fairly cheap 1.1 times book. And while the shares are down slightly on the year, it's still outperforming the overall market and producing that positive return when you add in that 8% dividend yield. This is a great one to consider if you're looking for those higher yields but are worried about some of the weaker players in that mortgage REIT space. Realty Income, ticker O, isn't the strongest dividend REIT on the list, but this one is extremely popular for its monthly dividend, so I wanted to cover it here. Realty Income is the only REIT in the Dividend Aristocrats list with annual dividend increases since 1994. In fact, it's got a 4.4% annualized increase in the dividend over nearly 30 years and a double-digit shareholder return. The company owns over 11,000 properties in the retail space, so it is going to see some weakness on the drop in consumer spending or a recession, but these are diversified across every industry within retail, so grocery, convenience, dollar stores, and restaurants. Not only do you have that good diversification, but many of these industries are more stable cash flows than your cyclical retailers like apparel or electronics. An interesting development lately is that Realty Income has started expanding internationally with 225 properties in the UK and Spain. Now, we are seeing quite a bit higher inflation in Europe, so consumer spending is going to fall there, but this part of the portfolio represents less than 2% of the company's total property, so not something that's really going to hurt the shares, and I like that idea of international growth for the future. And this is another REIT operating on that triple net lease strategy, so the tenant pays all the property costs, which makes for lower operating costs for the REIT and an average lease length of 9 years, so long-term leases to keep that cash flow stable. Realty Income has been able to maintain a 98% occupancy rate, more than 4% above the REIT average, really speaking for its careful process in leasing. Now, the dividend here is lower than most on the list at just 4%, but it's a monthly payout, which a lot of investors like it, and shares are in positive territory this year, beating the market by more than 12%. Next on our dividend REITs list, I wanted to highlight some REIT ETFs instead, with the Invesco Premium Yield REIT, ticker KBWY, with its 5.5% dividend, and the Invesco Equal Weight Real Estate ETF, ticker EWRE, with its 2.6% yield. Now, these haven't done quite as well as the individual REITs in the list, but since they are funds, you've got that instant diversification across property types. For example, the KBYW invests across small and mid-sized REITs and includes some of my favorites here, like Omega Healthcare, Gladstone Commercial, and GLPI. So not only do you get that strong 5.5% dividend yield, but also some growth potential on the smaller REITs and the stability across many different property types. The Equal Weight Fund holds more of those larger REIT companies and offers even better diversification with some great names here like Duke Realty, Extra Space Storage, and Prologis. So you might consider picking one or two of the individual REITs you really like, and then also putting some of your money in these ETFs to really just to spread out your investment across multiple property types. The KBWY has outperformed so far this year with a loss of 6.8%. Now, a loss, but still not as bad as stocks in the S&P 500. The Equal Weight REIT has performed right alongside with the market, but still provides a better dividend. We'll jump right back into our list, but I want to show you what to look for in some of these REIT stocks, how to decide which fits your portfolio best. We've talked about some of that analysis on the channel before, measures like funds from operations, but here I want to give you that bigger picture overview. The first thing you want to look for is what type of property does the REIT buy? So is it office space, warehouse, self-storage, retail, or data centers? This is important because most REITs specialize in just one property type, so you really need a good outlook on that one, or to build a portfolio of REITs around different property types. Next, you want to look at where the REIT invests. Now, most of these are going to be focused on the US property market, but even in that, it helps to find one with properties spread across a region or even nationally. It's important because a REIT with properties in just a few states could get hit if the economy there struggles or if a natural disaster hits. Tenant diversification is another important factor, and all of these are going to be available on a REIT's investor relations page. To find this, you just type in Google for the company and investor relations, and here you're going to find a company presentation and other docs showing you the property types, tenants, and other financials. That idea of tenant diversification is important because you don't want any single customer to be more than about 10% of your REIT's business, just in case that one tenant bankrupts. Here we see the breakdown for Realty Income, and you see even at the most, Walgreens is just 4% of the total rent, and the REIT is spread out across business types and by state. Also in this investor presentation, you'll find the occupancy rate for the properties, as well as a historical rate. Of course, the higher the better here, but more importantly is that consistency in occupancy. You don't want to see any big drops that could signal weakness in managing the properties, and it's great if it can be above that average occupancy of 94% in those large REITs. Before we get back to our list, I also want to share a resource for following REIT stocks. If you search on Google for NAREIT, so NAREIT, property returns or returns by property, you'll see this performance by property sector and subsector for the National Association of REITs. You can download the data in Excel, or I just like looking at the online version, and it's a great resource, totally free for following the returns to each property type. That's really important when you're looking at these real estate stocks because the returns and the outlook on one property type can be far different from others. So you really need to think about this in terms of not all REITs together, but what property types you like and the companies within each. For example, you can see here in the report that all equity REITs are down an average of 12.2% so far this year, with regional malls down 30%, and even relatively safer healthcare down 4.6%. But you can see how this can help guide your investment. Self-storage REITs surged 79% last year, and I warned investors earlier this year on the valuations to avoid this space, and here we see they're down double digits so far. I still like healthcare on that long-term trend, and even on that slight loss, it's helped protect your portfolio from the worst in stocks and some of these other property types. And before I reveal that best dividend REIT to buy, I want to get your input on this as well. Which is your favorite property type in REITs, or which stock do you like best from the list? So scroll down and let me know in the comments, how are you investing in REITs? And my top dividend REIT, maybe not for the reason you're thinking though, is WP Carey, ticker WPC, with its 4.8% dividend yield. Now, WPC is a $17 billion REIT with great diversification by property type. In fact, pretty evenly spread out across industrial, warehouse, office, and retail space. Most of the portfolio is in the US, though it does hold about 35% of the properties in Europe, which gives us some great geographical diversification as well. And that diversification is really why I like WPC for that best dividend REIT if you're just buying one in the space. All 5 REITs here are strong companies, offer some great dividends, and are good investments, but if you're only buying one REIT, then you really do need that diversification in the property type you get from WPC. With GLPI, you're only getting casinos. With Realty Income, you're only getting retail. And with Blackstone, it's only mortgages. But here with WPC, it's across several different property types and even that international diversification. The company collects over $1.1 billion in annualized base rent and books 98% occupancy over 131 million square feet across more than 1,100 properties. WP Carey has topped expectations for funds from operations over the last 4 quarters, reporting an FFO of $5.33 over the last year, so trading at about 16 times on a price to FFO basis, which is a really good value versus the 18 times FFO you see across the entire REITs. And the shares have done really well this year, producing a 7% return above that dividend yield and beating the market by 17%, so a solid performance. Click on the video to the right and get caught up on our Just One Stock series, the very best stocks in each theme for your portfolio. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.